Welcome back to the Deep Dive. Trying to keep up with the fast-paced world of financial news, it can sometimes feel like you're just navigating a really dense fog, right? One minute you're celebrating a company's big win, the next, maybe you're questioning its long-term viability. It's a lot, but that's exactly why we're here, to cut through all that noise, pull out the essential insights, and, give you the real story. Today, we're embarking on a pretty fascinating deep dive into Snowflake. That's NYSE, ticker SNOW. We're looking at their recent Q2 earnings report. And it's quite a tale of impressive numbers, ambitious AI plays, and some seriously high expectations baked in.
That's right. And our mission today, it's pretty clear. We want to extract the most important nuggets of knowledge, not just from Snowflake's latest financials, but also from how the analysts are reacting and where the company really sits in the broader market. We're going to look, well beyond just the raw headline-grabbing figures. We really want to understand the bigger picture. What truly propelled their growth this quarter? How is their AI strategy actually shaping up on the ground? And maybe most importantly, what does all of this imply for that intensely competitive data cloud landscape? So you'll walk away with a much clearer, hopefully more nuanced understanding of where Snowflake truly stands and what to watch for next.
Okay, so let's unpack this quarter from Snowflake. They really just delivered lots of people are calling a textbook earnings beat. It genuinely caught folks off guard, I think, but in a good way. Their earnings per share, the EPS, came in at a remarkable $0.38. Now, that figure didn't just meet forecasts, it absolutely crushed them. It soared past predictions by, what was it, a significant 41%?
41%, yeah.
Yeah. And the revenue hit an impressive $1.14 billion. That outpaced the consensus estimates by nearly $50 million.
Mm-hmm. Significant beat there, too.
Right. And to put that in perspective, that's a robust 32% year-over-year revenue jump. So as you might expect, the stock reacted pretty immediately, surged over 14% intraday. And for the year so far, it's actually up nearly 80%. Talk about a strong showing that really demands our attention here.
What's truly fascinating here, though, and it adds this extra layer of, let's say, nuance, is that this kind of performance is genuinely remarkable for a company that is still, by strict accounting measures, posting negative GAAP EPS.
Right, the GAAP number.
Exactly. Now, for our listeners who might not, live and breathe financial statements every day, GAAP EPS stands for Generally Accepted Accounting Principles Earnings Per Share. This is the standardized kind of conservative view of profitability and includes all the expenses like stock-based compensation, amortization, the works. So to generate such strong top-line growth and beat expectations so handily, even while operating under that negative GAAP figure, well, it sends a powerful message.
Definitely.
These weren't just good numbers. They were, I think, a definitive statement to the market. It signals not only Snowflake's operational strength, but also the continued, really robust demand for these modern data cloud platforms across, well, practically every industry. It just underscores how critical data infrastructure has become for businesses today. And that demand, it really isn't showing signs of slowing down.
That distinction, between the headline beat and the underlying GAAP figures, that's absolutely crucial. So digging a little deeper into that growth then, what specifically fueled it, and what are management's expectations looking ahead? We saw their product revenue alone hit $1.09 billion. That represents a significant 31.5% year-over-year growth.
Impressive number.
And what really impresses me is that this figure actually came in ahead of every major analyst estimate. Even their non-GAAP EPS, the earnings per share adjusted to exclude certain non-cash expenses like stock comp, gives a clearer picture of operational profitability that also cleared the bar at $0.35.
Also solid.
But perhaps the biggest signal of confidence, and where we really see management kind of putting their money where their mouth is, was their decision to raise their full-year product revenue guidance. They bumped it up to $4.395 billion. That implies a very healthy 27.3% growth, which is, a noticeable increase from their previous target of $4.325 billion. So what do these raised targets tell us about the broader market landscape?
Well, if we connect this to the bigger picture, right? This raised guidance isn't just a number on a page.
Yeah.
It's a very clear signal that demand for these sophisticated data cloud platforms, and especially for solutions that underpin increasingly critical AI initiatives, it just continues to accelerate. This isn't just about Snowflake selling more of the same thing. It's about businesses really across the board realizing their data is probably their most valuable asset. And they need powerful tools to manage it, analyze it, and now, crucially, to leverage that data for artificial intelligence.
Right, the AI piece is key.
Absolutely. We're seeing companies not just investing in data storage anymore, but actively seeking platforms that can support their, burgeoning machine learning and AI strategies, everything from data prep to model deployment. And Snowflake, with its sort of unique architecture, seems to be positioned pretty well to capture a significant chunk of this expanding market. This isn't just a Snowflake-specific trend either. It's really a reflection of a fundamental industry-wide shift towards more intelligent, data-driven operations. And Snowflake, well, they appear to be riding that wave quite effectively.
And, well, as you might expect after such a strong report and that confident outlook, the analyst reaction was pretty much a wave of overwhelming optimism. We saw numerous firms, including big players like BTI, RBC, Goldman Sachs.
Yeah.
They all quickly bumped up their price targets for Snowflake right after the earnings came out.
Yeah, the upgrades came fast. Exactly. Like BTI raised theirs to $276. Goldman Sachs went to $260. This widespread confidence from Wall Street, it reflects not just the perceived strength of Snowflake's core growth engine, but also the significant tailwinds they're obviously getting from this massive ongoing industry shift towards AI. It almost feels like the market is saying, okay, we believe in the data cloud and we believe in Snowflake's ability to capitalize on the AI boom. But this raises an important, maybe even a spicy question, doesn't it?
The spicy question.
Yes. Even with all this enthusiasm and positive news.
Right.
What about that valuation? Are investors paying too high a premium here?
You've absolutely hit on the crucial point. It really does raise that important question. What about the valuation? Because even with all this positive news, the stock's valuation remains, well, let's call it frothy or spicy, as you put it.
Yeah.
It's definitely up there. We're talking about the stock trading at 30.4 times its price-to-book ratio.
30 times book.
Wow.
Yeah. And for those maybe less familiar, price to book compares the market value to its net asset value. A high number like 30.4 suggests investors are willing to pay a huge premium per dollar of the company's actual assets. They're betting heavily on future growth, not current tangible value. Even more strikingly, perhaps, it's trading around 13.8 times its next 12-month product revenue.
Okay, 13.8 times forward revenue.
Exactly. This is a forward-looking metric. It tells you how much investors are paying today for each dollar of anticipated revenue over the next year. And if we even look out further to fiscal year 2026, with a forecasted EPS of $1.22, the stock's premium is just incredibly difficult to ignore. A valuation this high implies that the market has exceptionally high expectations. We're talking sustained, rapid future growth, and eventually profitability. Investors are essentially paying a premium now for that anticipated growth way down the line, which means there's very little room for error.
Yeah, no kidding.
Any stumble, any deceleration, even slight, and the market could react quite severely. It's a valuation that really prices in near perfection.
That's a critical consideration for anyone looking at this space, potential investor or not. Given this incredibly high valuation, the market must be placing huge bets on their future. And a big part of that future, presumably, is tied to their aggressive push into AI, right?
Let's shift focus there for a second. Snowflake has been making significant strides, we hear, with key AI products like Cortex and Snowpark. Are these truly gaining traction, and what does success even look like for them in this incredibly competitive AI landscape?
They absolutely are gaining traction, and importantly, the numbers are starting to reflect it, which is good to see. We actually have concrete figures for their AI product success. They hit $51 million in annual recurring revenue, or ARR, from AI products by July.
Okay, $51 million ARR from AI already. Yes, and they have what they describe as a clear path to reaching $100 million for fiscal year 2026. So these aren't just speculative hopes anymore. This is tangible revenue starting to flow from their AI initiatives. Cortex, for example, offers a suite of AI services directly within the Snowflake data platform. It lets users leverage things like large language models, other AI tools, without having to move their data out. Big advantage there.
Yeah, keeps it integrated.
Exactly. And Snowpark, that's their developer framework. It lets data engineers and data scientists build complex data pipelines and AI applications using familiar programming languages like Python, Java, Scala, directly within Snowflake. It allows for more sophisticated stuff like real-time anomaly detection or personalized recommendation engines. However, and this is a big however, despite Snowflake's undeniable AI ambitions and this early success, the competition in the space is absolutely fierce. We can't underestimate that.
Fierce competition is right. I mean, just recently, we saw Databricks hitting that staggering $100 billion valuation.
Yeah.
That clearly positions them as a colossal rival. What makes this rivalry so intense? Is it just about the market cap numbers, or are they competing on fundamental product capabilities and winning over customers?
Oh, it's much, much more than just valuation. It's really a battle for the very heart of enterprise data and AI strategy. Databricks, with its strong emphasis on the data lakehouse architecture and its, deep roots in the machine learning community, directly competes with Snowflake's data cloud approach. They're both vying to be the single platform where companies store, process, and analyze all their data for both analytics and AI. It's a head-to-head fight in many ways. And customer surveys, you often see indications that budgets are frequently being split between Snowflake and its competitors.
Ah, okay, so it's not always winner take all.
Exactly. It's rarely an all-or-nothing game for most large enterprises. They typically adopt multi-cloud or multi-vendor strategies for various reasons. Maybe redundancy, maybe specific feature sets one offers over the other, or sometimes just for negotiating leverage. What's more, we have to consider the double-edged sword of Snowflake's consumption-based pricing model.
Right, you pay for what you use.
Precisely,
Right, yeah.
which is fantastic for revenue growth during economic upcycles, right? Because customers pay more as they use more compute and storage resources. But it can be quite sensitive to macro slowdowns. Think of it like a utility bill for your data. If businesses suddenly need to tighten their belts and reduce data processing or storage because of economic pressures,
Snowflake's revenue takes a direct hit.
takes a direct hit and sometimes quite rapidly. This means their growth is closely tied not just to their own innovation, but also very much to the broader economic health of their customer base.
That consumption model definitely adds an interesting, maybe volatile dynamic. So, okay, when you pull all these threads together, the impressive growth, the aggressive AI push, the fierce competition, and that spicy valuation, what does it all mean for Snowflake's overall financial health? It seems to present a bit of a paradox, doesn't it? You've got this strong cash position, but despite that, those negative GAAP earnings we talked about earlier keep showing up. Can you help us make sense of this?
Indeed, it's a complex picture, but it's one that actually makes a lot of sense when you understand how many modern high-growth tech companies operate, especially in their earlier public stages. On one hand, yes, the company's still posting negative GAAP EPS. We saw $1.29 in Q1, never $1.89 now in Q2. And as we mentioned, this is that strict accounting view. It's heavily impacted by non-cash expenses, primarily stock-based compensation, which is a very common way for these kinds of growth companies to attract and retain top talent without burning through cash as quickly.
Right. It's a standard playbook for tech growth.
It is. But then, to balance this out, you look at their balance sheet and cash flow. They boast an incredibly robust cash position, $3.9 billion in cash and equivalents. It's a lot of cushion. And crucially, they generated strong free cash flow, $228 million last quarter.
Okay, positive free cash flow is key.
Absolutely critical. Free cash flow represents the actual cash a company generates after accounting for the cash outflows needed to support operations and maintain its capital assets, servers, infrastructure, etc. It's a real measure of their financial flexibility and sustainability, separate from those non-cash accounting charges. We're also seeing healthy, expanding margins, at least on a non-GAAP basis. Their non-GAAP product gross margin held steady at an impressive 75%. That indicates strong unit economics for their core product. It's profitable to deliver their service. And interestingly, they're actively engaging in aggressive share buybacks, which can be seen in a couple of ways, maybe a signal of management's confidence that the stock is undervalued, or perhaps more likely, a way to help offset the dilution from all that stock-based compensation we talked about.
That distinction between GAAP profitability or lack thereof and strong cash flow generation is really the crux of the story for so many tech companies these days, isn't it? So, okay, bottom line it for us. What's the ultimate takeaway here? If we distill all this down, what's the core narrative for Snowflake after this Q2 report?
Yeah, I think the War and AI takeaway from our sources really synthesizes this quite well. Snowflake's Q2 was fundamentally all about upside surprises on revenue, on earnings, non-GAAP, and importantly, on guidance for the future. That signals a momentum. Their ambitious AI strategy and their continued dominance, or at least strong position, in the cloud data platform space are clearly driving real, tangible growth. That's exciting, and it validates their market position to a large extent. However, and this is the really critical counterpoint for you, our listeners, that sky valuation, coupled with the razor-sharp competition from formidable players like Databricks, not to mention the big cloud hyperscalers themselves.
Like AWS, Google Cloud, Azure.
Exactly. They all have competing offerings. All that means This is definitely not a sleep well at night story for investors. Not at this price. The growth is undeniably there, the innovation is evident, but that price tag means you're paying for future perfection, as we said. So, the next battleground, and perhaps the most important one for long term investors watching Snowflake, will be whether the company can truly convert this incredible innovation, this market traction, and this strong cash generation into lasting, sustainable GAAP profitability.
Right. Getting into the black on the official accounting books.
Precisely. Can they do this before their rivals catch up further, potentially eroding their competitive edge or maybe forcing them into pricing wars that could start to impact those impressive gross margins they have now? That's really the billion-dollar question hanging over the company.
That's the core tension we've really explored today, isn't it? And it's a narrative playing out across, well, the entire high-growth tech industry, it feels like. Snowflake's undeniable growth, their impressive earnings beat this quarter, their clear potential in the rapidly expanding AI space. It's all incredibly exciting, and it validates their strategy in many ways. But as you've highlighted so well, all of this comes with a significant price tag, a hefty market valuation, and they operate within this highly competitive environment where achieving consistent GAAP profitability, rather than just strong cash flow, remains a key ongoing challenge.
Exactly. So, for you, our listener, maybe here's a final provocative thought to sort of chew on, building on what we've discussed. What do you believe is the right balance, that delicate balance between aggressive market share capture through relentless innovation, which Snowflake is clearly trying to do, and the fundamental, maybe old-fashioned requirement for sustainable traditional GAAP profitability in the long run? How do you see these dynamics playing out in other high-growth tech companies you might follow? Are there parallels? And if you are assessing Snowflake yourself, what specific measurable milestones beyond just revenue growth hitting targets or analysts bumping price targets, what specific things would you look for over the next few quarters? What would truly indicate to you that they are succeeding in this very intense battleground, especially on that difficult path towards sustainable long-term GAAP profitability? It's a question that has pretty profound implications, not just for Snowflake's future, but arguably for the future of the entire data and AI industry as it matures.